G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host David Shee, and welcome to join us for another Friday in terms of our usual property chat. And as always, I've got my best guy here, John Camino. How are you, mate?
Hey there, David. Really good, really good. Happy Friday. Love Fridays.
That's right, mate. That's right. You've gone through some transitions. Apparently, you're no longer living in your own home.
Yes,
So
that's right. Living with my in-laws, so every time I go out for a walk, it's wonderful. Any excuse to leave the house now. Any excuse to leave the house. They are wonderful people, I should say, though.
We
Living with
won't,
the
we won't
in-laws.
make you, to be honest, on the podcast. That's all right. But look, yeah, good to have you with us today, as always, John. I think it's good. Um, we're in November already. Geez, can you
Yeah,
like 2023 just goes like that, it's amazing how fast each year just goes and keep on flying by. And as we always have the data as well coming out. I think the quarterly CPI result last quarter wasn't that fantastic. I think the monthly CPI has actually rose its ugly head again. And that was mainly due to, I think, three key factors: the oil prices, the petrol prices, which we all know. That was also based on the rent, which is, we all know that's the affordability issue that we're going through at the moment, as well as I think some insurances premiums at the moment. Those are the biggest contributors right now in terms of the high CPI figures. But I think most of the economists has now put the bet from. It's interesting to see them that it was less than 50%, and all of a sudden after the CPI figure gets released, pretty much everyone swung to the other way.
yeah, that's right. That's right. You're right. We all went to the other side of the boat, and now it's tilting the other way. It's true. It's true. And I think the head economist at ANZ Bank, who's former RBA, she joined the bank, made a statement that we were done with rate increases, and then I think a week later said, "Got to put my hand up. I think there'll be one more." So we'll wait and see for Melbourne Cup Day, but the consensus at the moment is that there's one more rate.
You
One more
subscribe to
rate.
that as well, John? Do you think
Yeah,
it's pretty
yeah.
much a done deal right now?
I think so. I think so. I mean, the only caveat is that the market in the US is factoring in that there will not be more rate rises over there. I mean, I don't want to be sort of stuck in the present tense but overnight the 10-year yield dropped a lot, and the markets have shot up. The stock markets have shot up on the basis that the Fed's probably done. Now, the Fed raised rates a lot more aggressively than the RBA, so they raised rates by about another 1%, an additional percent over the RBA. So they're in a sense entitled to pause more than the RBA is. But the US is the reserve currency. If they're not putting rates up, we're going to have to follow more or less. But I still think that there's one more rate rise. But I think the big boys have stopped. But we'll see.
I guess just from a layman's term, I guess the key contributors to this September figure that we've known,
Yep.
like I mentioned previously, was the rent, was the petrol prices, and I think the insurance premiums. How are increasing another 0.25% going to help alleviate those? Is my question for potentially the RBA and for you.
Yeah, I don't think so. I would just add, because I think you mentioned initially petrol prices as well. So and I might address the petrol prices, which I think feeds into the insurance premiums a little bit. If they raise rates by 0.25%, that should strengthen the dollar, and that will push down the price. Okay. A stronger dollar will push down the price of imports, and if one of the biggest imports is oil, then it should push petrol prices down. But the way we think about inflation is completely upside down, as we've said on this podcast many times. That higher rents doesn't cause inflation. Higher inflation causes higher rents. And the reason we have inflation is because during COVID, we increased the supply of Australian dollars. We increased the money supply by 30% in 1 year. So that's why we have higher rents. Yep. Higher rents don't cause inflation. Inflation causes higher rents. But the way that they would be able to get CPI down is by strengthening the dollar and pushing down the price of imports.
Yeah,
theoretically, and oil being the biggest of those. Now, interestingly, at the end of the last quarter, which is sort of the last data sets, at the end of sort of September, oil was about $90 US a gallon. It's back down to about $81. Okay. So I don't think, and oil bounces around, but I think one thing that the market isn't taking into account is that the oil price came back about 10%, and that's not really reflected in the current CPI. So the CPI is going to benefit from the oil price going back down to $80.
Because it's always a rear view mirror type of view. It's a lag indicator, right? So yeah. Okay. So you think that this month's CPI figure will come down due to the, partly because of the fact that the petrol prices have also eased.
Yeah. I think there'll be a realignment back towards expectations. But once that the RBA has flagged that rates are most likely to go up, they kind of have to do it then. So I think that there will be a quarter of a basis point increase. If there isn't, it's probably because the oil price came back down and they felt that they didn't need to do it. But I suspect that consensus generally prevails with these things. They don't like to be too surprising.
Yeah. Okay. All right. Well, fair enough. I think all the mortgage borrowers unfortunately have to buckle down again for another potential rate rise. In this case, there's also talks about potentially another 0.25% in December. What do you think the likelihood of that could be?
I don't think so. I'm actually becoming quite generally pessimistic. Not on like the real estate market, which we'll get to. Still optimistic about that, but I think that rates rose too quickly, and that what I thought was going to happen probably is what should have happened, which is that they let rates go too low during COVID, and raising rates as quickly as they have done would be too dangerous. So therefore, they would let inflation burn a little bit. And they didn't. They became a bit too hawkish on inflation.
Yeah.
So I think we're kind of stuck now that rates are really quite high for the amount of debt that we have. We know in the US the interest on the national debt is over $1 trillion now. Now, bearing in mind that the military budget in the US is about $800 billion, so the interest on the debt is far greater than the Pentagon budget. I think there's a reckoning that will happen in 2024, and I don't know what it looks like, but it's not going to be good, and I think it's quite soon, whatever this reckoning is. And if this reckoning happens, interest rates might have to come down by mid next year.
So some sort of event essentially that's going to trigger that to initiate the US markets, the Feds, the ECUs, essentially to look at putting that down.
Yeah,
the quicker they raise it, the quicker they have to basically come down as well.
It's too quick. Too quick for the amount of debt that's in the system. So we're too indebted. So you could do, so if you take the 80s compared to now, so they raised interest rates from about 8% to about 19% under Paul Volcker at the end of the 80s. So that was double. Now what they've done now is taken interest rates from about 0.1% to about 5%, which is interest rates up about tenfold. Was my maths good enough? So that's much, and in 1 year they did that. So the shock to the system is far greater. There has to be a reckoning. I don't see how we get out of that. But we'll see. I mean, higher interest rates is good, better for the system, but they did it very quickly. So we'll see.
Okay. All right. Okay. So if there's another 0.25% in November, and I know it's probably always a bit too early to tell when it could be coming down. Funny enough, a couple of months ago, the economists are already predicting in terms of when it's going to come down at this point. But John, given the latest information that we have, do you think is it too early to say it's probably going to come down at one point, even in 2024, 2025? Or I know it's just pure speculation here.
Oh man, the forecasting game. Forecasting central bank policy is fraught. So whatever I say next will be wrong. And every economist, and I'm not an economist, but every economist always says second half of next year. Every year they say second half of next year. So look, I mean, I just think something will snap before June. So I think that we might be March or something like this, but that's certainly not what's baked in. What's baked in is high rates in Australia. But yeah, I do think 2024 they'll start coming down.
Sure. Okay. All right. Okay. Well, thank you for that. Look, I think it's good to get a bit of insight on what John's thinking on this side of things, which I know a lot of our listeners are very interested in knowing about. So, but let's get into the more interesting stuff as well, John. I think the core logic data for November or October, I should say, because it just got November. The core logic data in November has just got out, and we'll do the same thing as what we did last time. So I'm going to basically share the screen so our listeners can, or viewers can actually go through it with us. As for our listeners, unfortunately, it's best to jump on the YouTube channel, so that way you can also get to see these things. It will be a lot easier to follow when you have the screen in front of you, but regardless. Okay, so
you've done some highlighting.
Yeah, mate, John, I've done my
to you.
Done my homework. Try to do the best to try to use these as a bit of a conversation starter, essentially. Okay, so headline. So home value index has gone up again, 0.9% for October. Okay, but there are some downside risk emerging. And basically the first page here, there's a lot of things, but yeah, I try to highlight out the ones as a bit of our key points that we can use as a conversation starter. So the one thing is, since finding a trough in January this year, the national HVI has increased 7.6%, leaving the index only 0.5% below the historic high recorded in April last year. So we are basically back at the highs, at the peak, as we were last year. Okay, so pretty much no difference. And at this current rate, we will see the national HVI reach a new record high midway through November. We're already like early November. In 2 weeks' time, we will pretty much at a new record high. It's amazing how whenever we look at it, within 10 months, it literally bounced all the way back when everyone's kind of expecting it's going to go the other way, right? So, but I think the other thing now that we look at this is each market's starting to do its own thing. Like we're talking about different capital cities run at a different rate. We are expecting there's going to be a slower rate of appreciation, can probably be attributed to a combination of higher advertised stock. So at the moment, John, I'm sure you're seeing this, a lot of available properties on the market. Sellers are now trying to get rid of their stock, selling down, pay off a bit of debt, try to make life a bit easier, be able to hold on to the properties. And that advertised stock, alongside with the stretch affordability, is probably what's going to slow down in the next couple of months the value of the appreciation in the next few months. So that's what Tim Lauders is actually thinking in that sense, with the higher level of stock along with the stretch affordability. Okay, so we can't just keep pushing prices up forever. There's going to have to be a line at some point in time. And I think we're very, very close to that level now where it starts to go neutral. But like I mentioned, the properties are actually going at different paces for different national cities. So, we're seeing very strong capital cities like Perth, Brisbane, Adelaide. Perth at 1.6%, Brisbane at 1.4%, Adelaide at 1.3%. These are the cities that continuously to be favoured by the investors, basically, or most investors and our owner ox, because of the affordability they can see at the moment. Whereas on the other side of the equation, we've got Darwin, who's unfortunately going through a negative, as well as I think Tasmania was the other one as well. So so different property. I think it's just this is what we've always seen. Like, it's a very rare instance during COVID that all the markets are accelerating at the same time. I think now just basically going back to what they used to do. Every capital city is doing its own things, depending on affordability ranges. They're running their own races and growing at different levels or decelerating at different levels.
Yep.
Also worth highlighting, Brisbane housing value posted a nominal recovery in October, erasing the previous minus 8.9% drop in values to reach a new record high. So Brisbane's already at a record high now. Yep. Perth and Adelaide are also at a new record highs after recovering from shallow downturns earlier this year. So these three capital cities, why I can understand most investors are eyeing at them at the moment.
Yep.
Remaining capital cities does have a bit to go. Sydney value is down 0.2% in January. It's the January peak. Melbourne minus 0.7% below the March 2022 peak. Hobart down the most from their recent highs. Tassie's. It's 11.6% below the peak levels. So I think those are kind of like the highlights. Oh, also, okay, regional Victoria. Funny enough, actually, I think Victoria is going to grab the headlines very, very soon. We've been speaking about this for a few times now, John. But regional Victoria remains the softest of the rest of the state regions, with housing values holding virtually flat over the rolling quarter, holding minus 7.2% below the May 2022 peak. The soft conditions comes amid rising stock levels, 27.2% higher than a year ago, and 11.1% above the previous 5-year average and low demand. So I think those people looking at regional Victoria, Geelong, Ballarat, Bendigo, just a few of those capital cities at the moment, there's a lot of available properties for sale, not much demand at the moment. So that could be a lot of...
there's a lot of alienation of wealth and wealthy people in that state. But fortunately, governments change, but it has been a very hostile government to wealth, to landlords, to property investors, and so on. So, but these things are transient.
Cool. All right. So index results. So I'm not going to go through. I think we've pretty much covered most of it. But yeah, it's interesting to see how Brisbane median value is only about $8,000 out from Melbourne.
Yes, that's right. That's right. Brisbane's about to overtake Melbourne.
About to overtake.
Reminds me of when, remember in about 2005, 2004, Perth was momentarily more expensive than Sydney.
That's
I remember that. And it reverses. It changes. I think this will too. But it's interesting to see that.
I think Melbourne continues to prove to be good value in the long run. But it is vastly undervalued, as I'm sure if you do a graph, you're using your gold ratio today, probably would have been one of the top 3, if not top 2 now.
It was Melbourne and Perth when we last did it in July.
Melbourne and Perth,
and I can imagine Melbourne's now probably standalone as the cheapest capital city.
Indeed. All right, moving on. So I think, you've got the rolling 3 months changing values, etc., etc. So I'm not going to go through these all up. Okay, so a bit more summary. In terms of the stock level. So after 10 months of below average vendor activity, the flow of new capital city listings has ramped up through winter and spring to be almost 12% higher than a year ago. So we're seeing a lot more stock levels coming onto the market at the moment. Although the total listing, so the new listing plus the relistings at the moment still remain lower than this time last year and below the previous 5-year average. Okay, but it's clear that the inventory levels are rising. So more properties are available for sale. A lot more sellers coming onto the spring market now. Obviously, try to sell off their property. But at a holistic level, we still haven't hit even 12 months ago, let alone 5 years average at the moment. So, but that's what you're seeing at the moment, John. I'm assuming you're also seeing a lot more available properties for sale, in the last month or two.
Yeah. So just a couple of comments on supply. So there is more supply. It's spring, so there ought to be more supply. And so there's nothing unusual there. It's hard to find. There's a very limited supply of good quality stock. So they're selling really fast. And I think that while I think supply is up, I think you can't look at supply without looking at demand at the same time. And I think that certainly demand and supply are matching. There's more demand as well. But my main concern with the conversation about supply is, as we said, actually off air, was that what you really want to look at is population adjusted supply. So if we're back at the average of the last 5 years in terms of supply, that's great if our population was stagnant, but our population is going up at 500,000 people a year. It's like 1.5 Canberras every year that we need to build. So we have many, many more people than 5 years ago, or the average of the last 5 years. And if we're just going up to the average of the last 5 years with 2 million more people, we still have a shortage, which is why what is actually more informative, I think, than the supply going up is actually what's the vacancy rate. And the vacancy rate dipped again in October.
Yep.
That's the vacancy rate is in a sense population adjusted housing supply, and it's at 0.8%. So we're still way short. Supply's up, but there's more of us and there's more demand. So
Yeah.
you've got to adjust this stuff for population, I think, which is why vacancy rates are probably the best we're going to get for an indication. And it's sort of the canary in the coal mine. The rental market's very fluid. You don't need to go to the bank and then wait 6 weeks for approval. You can go out and rent a property anytime. So it's a very nimble part of the market, very agile, very fluid. It's telling us that we've got a housing shortage. So yeah, vacancy rates.
I think it's been screaming at us that has a rental shortage for a while now, based on the numbers so far, right? But it's interesting to see, obviously, the stock level started to come up, and it sounds like it's actually a lot higher. And like maybe it's just part of spring, maybe it's more sellers now feeling the pinch, in that sense, and try to sell off the investment property or few investment properties to be able to liquidate a bit more. So but even the stock level has diversities as well. Again, so at one end of the spectrum is Perth, where advertised stock levels have fallen through spring to be minus 0.2 to minus 2.1% below levels recorded at the end of the winter. So Perth supply level continues to trend down. Listing numbers have also hardly budged in Brisbane, which is about 0.5% increase, or Adelaide 1.6% increase. Okay, so there's a bit of diversity in those. On the other side of the spectrum, ACT total listings have jumped 21.3%, basically. So ACT's got a lot of properties at the moment that's on the market, flooding out. While vendor activity has picked up, home sales are tracking only slightly above the 5-year average across the capitals and are losing some momentum. So yes, there's more stock available for sale. However, the number of transactions or sales listings has not necessarily kept up, in a sense. So what Tim has commented on this is saying, with vendor activity gathering some momentum while buyer activity slows, it's likely selling conditions will continue to rebalance toward buyers, especially in those cities where advertised supply levels are high. In markets where demand and advertised supplies are more evenly balanced, it's logical to expect price growth to slow down. In other markets, such as Perth, where listings are almost minus 45% below the 5-year average, while sales activity is almost 25% above average, prices are rising at the fastest pace since March 2021. So yeah, so I think I think it's just kind of explains a lot in terms of why Perth at the moment is the hottest investor market in Australia.
Yes,
fingers down.
Word of warning though, so I agree. We do our ratios of capital cities, and listeners, you should definitely check that video out where we go through every capital city, and we compare, and we do the ratio of Sydney to the capital city. We also compare Sydney to gold, which we can come back to. The only caveat in the Perth market, and I don't know a lot about the Perth market, but it's about 50% investor, which means that you would expect it to be about 30% investor, 70% owner occupier, and that's what a healthy market looks like. So you want more owner occupiers. At the moment, Perth's about 50-50 investors to owner occupiers, which introduces potentially a fickle buyer into the Perth market. So while I think Perth has got more to run, I think it's going to outperform the other capitals. You just need to be careful whenever investor levels go that high. One of the reasons why back in 2021, I was convinced that it wasn't the big bubble that everyone thought it was that in Sydney at least, was that investor levels were very low. So all the speculative buying back in 2021, when everyone was saying it's a massive bubble, there were no investors buying. So you need investors. You need a high proportion of investors to mark the end of a cycle, to mark a bubble, a boom. We maybe have that in Perth, although I think it's got legs. You don't have that in Sydney. So prices are high, but that doesn't mean there's a bubble. You need high supply and you need lots of investors. That's what makes a bubble.
And I think supply is having exactly the same issue there up at Perth at the moment, which is
Yeah.
why it's also accelerating, right? So
Mm.
the owner occupiers in the Western Australia states are certainly looking at buying as well. But
Yep.
yeah, there's unfortunately nothing to purchase. There's no
Mm.
listings. They're not building things fast enough as well. So I spoke to David Hall,
Yeah.
who's obviously
He's great.
he's our Perth guy. Yeah, he knows that market inside out. He's saying exactly the same thing. So in short period of time, this supply issue is not going to go away, basically, unfortunately. Okay, interesting. Yeah. Okay. And the new listing, I think looking at this graph as well at the moment, it still seems to be trending up. But again, it's still below the 5-year average at the moment. So that's a very visual way of being able to
And
see.
again, not population adjusted. So if I
Correct.
think the vacancy rate it's a bit further down, and that's an indication.
Let's talk about
There we
vacancy
go.
rates, given John how you want to do it. So, all right. Well, rental vacancies fell to a new record low in November. So 0.9% across the combined cities and 1.2% across the combined regional markets. Nationally, rental listings were minus 35.5% below the previous 5-year average over the 4 weeks ending October, and minus 16.1% lower than a year ago. So definitely have a big supply issue here. That's not, and it's mainly now, as you said, John, this is now factoring in the population.
Yeah. The one thing I'd say is, there's always the question when you have a housing shortage, and there is a lot. The construction actually is down because interest rates are up. So I don't see a solution to this anytime soon. But the question is always, out of what we're building, are we building the right things? And there were some articles in the paper during the week about whether foreign students coming in is skewing the housing market. So foreign students live in 1-bedroom units, or they cohabitate maybe in larger apartments and they rent the room. But generally speaking, if you've got people coming to study at Macquarie University or UNSW, that they'll rent a 1-bedroom apartment nearby. So that's what we build. We build 1-bedroom apartments. Now, 1-bedroom apartments are great for students, but they don't solve a broader housing shortage. So if you're after if you've got a family, you're in trouble because we're not building 3-bedroom units or houses for families. So there's always there's only so many bricks, there's only so many laborers, there's only so many electricians around. So where we allocate those scarce resources to, in this case, 1-bedroom units near universities, is pulling resources away from building other types of dwellings for other types of family types. So that's another interesting conundrum. But if immigration if population growth goes to 500,000 a year and stays at 500,000 a year, the economy will get used to that. We'll plan for that, and then we will. But if it goes up to 500,000, then up to 700,000, then down to 200,000, the economy is sort of discombobulated. It doesn't know what to build. Yeah. But if immigration levels stabilize, then the market will adjust to that, and that's no problem.
Yeah. Well, that's the difficult part for for everyone to play, isn't it? It's just we know how much immigrants are coming in, but as you rightly pointed out, developers are not making profits from building, and therefore they're not really building in that sense. So I think it's just going around in circles at the moment, right? We have a shortage issue. We know we need to build more, but we can't build more because of high rates and because that lower profit margin. So therefore, less incentivized builders to actually build more at the moment. And it also depends on what they want to build. As you rightly pointed out, it might be more profitable to build 3 times 1 bedrooms rather than 1 times 3 bedroom.
Yeah, that's right. So
not really solving the fundamental issues at the moment. So and that seems to be, and that will continue as well, unfortunately, for the foreseeable, at least for the foreseeable future that we're seeing. But having said that, in terms of the rental supply, despite such tight rental supply, the pace of growth in rents has generally lost some steam and has become more diverse. I personally think that it's more to do with affordability. I think even with the affordability on purchases as well. So there's only a certain room for values to continue to go up for those people who requires finance and credit. Same thing to the renters to a level as well, right? There's only a certain allocation of their net income that they can allocate. And now it's starting to hit that affordability range as well. So
Yeah.
how much more
Yeah.
will your rent continue to grow?
Well, renters can move to cheaper areas and pay the same rent. I mean, that again, it's a very fluid part of the market. One thing I'd say about the rents are definitely coming off in terms of the growth rate in the rents. They're definitely coming off in units. They're kind of plateauing at 10% growth for houses. So I'm not persuaded that houses, except for in Adelaide and Brisbane, which has sort of fallen from 14% to 6% growth. For Sydney, Perth, Melbourne, rents are growing at 10% per year, and they're not coming off, but unit rents are definitely coming off in terms of the rate of growth.
Why do you think that's the case, John? Like, are people coming back to seeking houses again over units because of that difference between the rent on the houses, or rent on the unit is now closer to houses? So therefore they go, if I can spend $100 more a month in terms of getting a house, then I might as well do that.
Well, it's hard to know. I think it's partly to do with what we're building, which we spoke about a couple of moments ago. But I think the other reason is that unit rents went up much more sharply as they opened the spigots for students to come back in. So I think there was a bit of a sharper increase up to sort of like 17, 18%. So it's coming down to 12%. Whereas I think house rents didn't go up as sharp. They sort of went up to 12%, and now they're at 11%. And I just think there was a bigger shock to the apartment market for renters.
Yeah. Okay. All right. Fair enough. Okay. And gross rental yields look to have peaked as values continue to rise and rate of rental growth accelerates. So yeah, that
surprises me. Generally speaking, the yield will converge with the interest rate. So if you've got we saw this on the way down, didn't we? You know, interest rates fell, and so prices rose until the yield matched the interest rate, which was about 1% at the top. So I don't see yields falling unless the interest rate rise cycle is over. So I still think that yields have to go up a bit more. I don't agree with everything in these reports, by the way, and I think that's one thing that I think the yields have to. Rents will still rise faster than prices because the yields still need to get to around 4 or 5%, which is where the interest rates are. So I think that they're wrong on that.
Yeah. So
in my opinion,
the value of the property prices will continue to grow, but it's not going to be at the pace of the rental growth. So in other words, rent growth is going to be higher than the value growth from this point.
Yeah. So that's right. While interest rates are around 6%. And yields are say 3.5%, rents will grow faster than prices, so that the yield and the interest rate will converge.
Yield will continue. Okay.
Yeah.
Well, we'll see in a few months' time.
We'll see. I mean, in a couple of years' time.
That's it. All right. So coming to a bit of a summary page, the outlook for housing market isn't as positive as it was a few months ago, with advertised stock levels on the rise, while buyer demand looks increasing shaky amid low sentiment, stretched affordability, and the potential for another rate hike this month on a cup day. So that seems to be the general consensus. While the advertised supply is likely to rise further through spring and into early summer, the prospects for buyer demands just aren't as positive. Consumer sentiment is already deeply pessimistic, holding at similar levels to the early stages of the pandemic and the worst of the global financial crisis for more than a year. So I think the high interest rates is just curbing the demand right now in that. And it's been very difficult to access credit, that's for sure at the moment. The wash up is that we were likely to see a further reduction in the rate of growth in housing value over the months ahead, alongside increased diversity in capital growth performance. So yeah, like we mentioned before, essentially the capital cities will be running at their own pace, The Perth, Adelaide, and Brisbane market will probably continue to do relatively well. Sydney markets, Melbourne markets, these are the ones that's got a bit more leverage. They will be impacted a lot more by interest rates, and they could decelerate a little bit faster than what it is. But overall, I think, John, I guess what this tells me is the markets are rebalancing. I think that's one of the key things that, in terms of taking away, is yeah, it's rebalancing from basically a seller's market for probably the last 9 months or so. It's starting to shift towards more of a balanced market as we have more supply coming through, but it's not a buyer's market either, as well, because there's not enough demand coming through, not enough buyers who want to buy, and that's purely due to the cost of credit right now.
Yeah. Yes, I think prices are still rising, and my view is that they'll probably continue to rise for the next 2 years, but we'll see. The peak and the rate of growth, and we have to distinguish between whether the market's growing and the speed at which it's growing. But I think the peak rate of growth was back in June, but there was a bit of a resumption in growth quite recently, so it's still growing quite quickly. One thing that ties it into the gold to real estate ratio is that all the currencies got smashed in October. The prices, the value of our currency went down. Yep. Gold spiked. That in real terms pushes the value of all Australian dollar denominated assets, including real estate, down. So in real terms, so in Sydney, prices went up by 0.8%, but gold went up by about, I think, 5 or 6%. So in real terms, Australian property prices came down. Priced in gold or priced in US dollars or priced in something that's not losing value like Aussie dollars, prices came down. I think we've got a long way to run on this real estate upswing, which doesn't have to be a massive upswing, but I think prices are going to continue to rise because I think that the Australian dollar is going to continue to fall. I think the US dollar is going to continue to decline, and all currencies are losing value. So prices of assets in these countries need to reset higher, and I think that's partly what's happening. It looks like a real estate bubble, but it's actually currency decline.
Okay.
The value, yeah. So when the value of gold goes up, the value of the property is going down. So I don't think property prices are going up as quickly as we think they are in real terms, and they're struggling to keep up to the decline in the value of the Aussie dollar.
Yeah. It's you're talking from a relative perspective at the moment, isn't it? Yeah.
It's like inflation adjusted prices; they're still falling.
Yeah.
Okay.
All right. Any other takeaways out of this month's values?
No, very thorough. I mean, at the end of this is so houses are still outperforming units, and I think that's interesting. And I think this is also, so if the listeners can download this themselves, it's quite interesting to pore over the best performing suburbs. And for the last 12 months, it's been Marrickville to Sydenham and Petersham, which is very interesting because that's where the new part of the metro that goes out to Bankstown is. So there's a real sort of focus that's growing at about 14.9%. Baulkham Hills, Hornsby, Blacktown, Burwood, Strathfield, Canterbury, Leichhardt, they're the best performing suburbs over the last year. And I was going to say, there doesn't seem to be a theme, to be honest. I mean, the first one's about the metro. We'll talk a bit more about that later. But then there's Blacktown pops up. I bought a lot of properties in Seven Hills, Blacktown over the last year, and I think those areas are doing really well. But yes, I think for all the listeners, you should pore over this back page, which has got some specific suburb performance data.
Yeah, that's the SA3, which is basically I think it's from a council level as well.
Yeah,
so
LGAs.
Aggregated, not specifically the, say, Baulkham Hill suburb or Warringah suburb. It's about the aggregate of that council area, which are performing quite stellar in that sense. So, but yeah, definitely check it out from this CoreLogic report, which gets released every month. By the start of the month, it shows the performance of the last month's report. So, yeah, awesome. All right. Thanks, John, for the wisdoms as always.
Thank
So
you.
that's I think that's enough for the HVI home value index that we have.
Yeah.
Back to our interesting topic for this week, I think we should say. So how should I put this? John is very keen. Okay, let's
Very
put it this
keen.
way. Everyone who invests in property has obviously heard of hotspotting. We don't like the term, or I personally don't like the term as much. Okay, but I guess the way we put it is John has got a few suburbs which he's sharing for free today, as a matter of fact. Sharing for free for our listeners in particular, in terms of how he thinks these are going to be the ugly duckling suburbs in 2024 that's going to perform quite well. And we're talking about specifically in Sydney. Okay,
yeah.
Sydney houses as well. I think it's important to clarify.
Yeah,
houses.
2024 hotspots.
Yeah, in 2024 and onwards, not just 2024, I should say 2024 and onwards, in that sense. So yeah, I think it's good for you to be able to share this and basically explain a little bit of understanding on why you think this is the case on these suburbs as well. So that way, you know, we can get a bit of insight on those. Yeah, so I think we've narrowed down to how many we have. We've narrowed down to about seven suburbs, which John is going to be able to share with us today on how he thinks that these are good values. So, John, would you like to kick off the first one?
Yeah, definitely. Well, I just want to reiterate what you said, David, is that we hate to hotspot, but you got to give the crowd what they want. But you should always, I mean, if you want to invest in the best suburb that you can afford, the best suburbs will be the best suburbs in 50 years' time as well. So don't let that stop you. But here are some suburbs where I think that there's a bit of a mispricing, and where I think that there's events that are happening on the ground, like infrastructure, for example, that will drive prices a little bit higher than average, or growth rates higher than average over the next couple of years. Okay, and there are a couple of suburbs that are nearby to each other, which I might group together, but we'll see how we go. Sure. So the first suburb I have is Eastlakes, but I've sort of combined that with Matraville and Botany. Okay. So Matraville and Botany, and the reason that I like Eastlakes, Matraville, and Botany is mainly the ripple effect. So these suburbs are broadly speaking sub $2 million. In neighbouring suburbs like Maroubra, Kingsford, Kensington, that are about $5 million to buy property, $4 million. So you do a 3-minute drive and the prices double. Now there are good reasons why these suburbs are cheaper than the neighbouring suburbs, but and I don't think that there'll always be a gap, but there is a very distinct gap between these suburbs and the neighbouring suburbs. So Botany and Eastlakes have median house prices under 2 million, under 1.9 million actually, whereas Matraville is more like 2.3 to 2.4 million. Eastlakes is under 9 kilometres from the CBD. Matraville and Botany are both about 12 kilometres from the CBD. So we're talking about suburbs near the beach, near the cafes, near the city. I just think that these are mispriced. I think there's very limited downside. So if you were to buy in somewhere like Eastlakes, I don't know what the downside risk is. Now, devil's in the detail. Botany's got factories. I think that so Botany's like a longer term. I think that those factories will go. And there are lots of semis in those areas which play with the price. So if you want a freestanding house, they are hard to get under 1.9 million or even under 2 million, but it's doable. And I've done it recently for clients. So yeah, Eastlakes, Matraville, Botany. I think those areas are going to do really, really well over the next year and beyond.
And this is and these three suburbs are kind of more towards the eastern side from CBD, isn't it? So
southeast,
southeast,
yeah. No, really well, and that they are. You could. I haven't got Mascot in there for various reasons, but there are reasons for that, but all these areas I think are great. And also, there's aircraft noise in some of these parts of these suburbs. You've got to be selective, but I think that these areas are great. And also, as the kids of people who grew up in the eastern suburbs can't afford to live where their parents are, they need to find alternatives. Ditto the inner west. So they're moving to places like Eastlakes and the St. George area to be close to mum and dad, without having to pay the prices that mum and dad paid. So yeah, so I like those. Okay, should we move on?
Let's do it.
All right. The next suburb is Longueville. So this is a little bit premium now, but Longueville is an area with harbour views. I think it's the forgotten premium suburb. It's starting to emerge in the list of like the most expensive parts of Sydney, but it is cheaper than the other blue ribbon parts of Sydney. And the reason for that is it's sort of a bit of a peninsula. You've got one side of the peninsula with views of the harbour. Yep. The other side has water views, but not of the harbour. So you get a lot of variation in price. And I bought in Longueville for clients as well. But man, like it is about as cheap as you're going to get a water view or a harbour view. And it's beautiful. Now, I think one of the things that keeps the lid on the Longueville price is that it has the same postcode as Lane Cove. Lane Cove is my number 5 pick, but the Lane Cove postcode, I guess, covers a couple of areas there. But Longueville, I just think it's 9 kilometres from the city, harbour views, fantastic opportunity. I don't think it's fully exploited for the amount of upside you get. I mentioned number 5 is Lane Cove, much cheaper than Longueville. And Lane Cove is sort of considered entry level, lower North Shore. But Lane Cove used to be a bit of a retirement village for Sydney's retirement village. It used to be an old person suburb, but recently they've done the canopy. If people might have heard of the canopy there, drawing families. So in Lane Cove, you're 9 kilometres from the city. You can get big blocks of land. It's young, it's vibrant, there's cafes and all that sort of stuff. It's like Chatswood without the train station. So it's quite charming and it's drawing a lot of attention. And essentially in that area, you now want to be near the village because it's drawing families to the area. So Lane Cove's really good. Lane Cove grew 13% this year. So it was just outside that list that we saw a couple of minutes ago, but 13% growth over the last year to date.
You're building a lot of units around the canopy.
Yeah.
Isn't it?
Yeah.
Basically new units or newer units, I should say.
Yeah. That's true, but that supply has stopped. So that supply came on board about 4 years ago. There's no more supply. It's a big suburb. There are lots of units, but they're quite affordable. And I am mainly talking houses at the moment, but I think that if you had a sub $1 million budget and you wanted to buy an apartment, Lane Cove is pretty good as well.
Also close to Chatswood as well.
Close to Chatswood, yeah, cheaper than Chatswood, much cheaper. Yeah.
Mm.
All right, that was number 5. Number 6, 5 Dock. So the inner west gets a bit of a. Oh, 5 Dock. So 5 Dock has a median house price of 2.2 million. And it's 9 kilometres from the city. So this comes under my broad theme of Metro Mania, the Metro. So this is the new Metro that goes, I think, through Drummoyne and out to Parramatta. 5 Dock is a lovely, charming area. And there you've got a different parts of 5 Dock. It's already an expensive area, but you've got the part on the bay for the bay walk where you might see Tom Panos, and then you've got other areas sort of on the Croydon Burwood side. But there's a lot of speculation about the rezoning that's going to need to happen in 5 Dock to accompany the metro station. And I just think that it's going to attract a lot of people. I know my clients come to me and they talk about 5 Dock in a way that they never used to because of the metro station that's coming in. Now, locals are concerned it's going to turn into Burwood and Ashfield. That may or may not be a good thing. But 5 Dock, yeah, you can also get apartments there under $1 million that are fairly good value. But I see 5 Dock being a very good place to have your money over the next 5 to 10 years as well. But I'd be looking out for it in 2024 as well.
if it becomes Burwood dies to a degree,
Yeah, Burwood.
come out with new terms every time.
Yeah.
Do you think it's going to have high rises as well, just to planning and in order to fit into that density requirements, especially when new metro has been built in?
Yeah, that's what they're talking about.
Yeah,
They are talking about how high the rise needs to be in the area. And
they,
if they don't do it, it'll just make it more valuable.
if they do, do you think that units around 5 docks would still be a good long-term investment?
It all depends on how dense it goes and how it gets rezoned. But if supply goes up, as it would in that situation, demand would go up as well. So we'll see, but we would see. But I think for now, particularly before the new high rises have gone in, at the moment it hasn't even been rezoned. That's why I think right now it's an excellent opportunity.
Yeah, fair enough.
Yep. And bear in mind the neighbouring suburbs, Croydon, all these parts of Sydney are sort of implied in this list. All right. Number 6. Number 7, the last suburb, something a bit more affordable, but it is Metromania as well. Punchbowl. You might say Bankstown as well, but Punchbowl, that Bankstown to Lakemba corridor. Okay, why do I think Punchbowl? So the median price there is 1.1 million. Although good luck finding something for 1.1 million. It's a bit higher. It's under 20 kilometres from the city. So I always like the Bankstown area from a dartboard perspective. If you have a map of Sydney and you're playing darts, if you get it close to the CBD or Hurstville, it's a very well located part of Sydney. Not for everyone though, but I feel like it's cheap. Tom Panos, I'll mention him again. He sold a house in Bankstown last week for 1.7 million. Just a relatively unremarkable house. So you're starting to get those sorts of prices. So there is a recognition that the Bankstown LGA is undervalued. But the main reason is the metro's going through, and the metro and access to Bankstown is also going to be one of the major hubs going into Badgerys Creek. So I think that whole area, which includes what I think is undervaluation within a 20-kilometre radius of the CBD, plus all the new rail infrastructure that's coming in. I think Punchbowl, Bankstown, Wiley Park, Lakemba maybe, not for everyone, but I think that they're representing very good value. I also saw, just to wrap on Punchbowl, I was doing some research myself the other day, and I saw a proposed rezone map of Punchbowl, and you never, buying on the promise of rezoning is very, very dangerous. So I'm not recommending it, but they are considering a very generous rezoning of the area around the station there. So that's something to consider as well.
Interesting.
Yeah.
Demographic wise, from Punchbowl, Lakemba, these kind of areas, is that the reason why it's still relatively affordable at the moment?
What was the question? Why is it
demographic?
Oh, yeah, I think so. But if you look at the vacancy rates around there, they're about 0.3%. 0.3% for the vacancy rates. So none of it's been rezoned yet. That may or may not happen. And there is a lot of demand as well. So 0.3% for vacancy rates there.
Yeah, it's crazy.
Yeah. Now, obviously, this is not advice. You really should do your own research. I need to disclose this. These are, and it may not happen next year. Maybe it grows at average rates, but these are just my opinions. I would also say that I have some interest in some of the areas that I've mentioned, so it's not entirely unbiased. So you should be aware of that as well.
I guess another way of looking at it is if you have already bought into these areas as well, then you've certainly been eyeing these suburbs for a while now. So you kept the cards close for a couple of years. You got in, but now you're openly sharing it with others.
Some, not all. I'm happy to recommend places that I have no interest in, which is the majority of the places I've mentioned. So.
Fair. And it's also worth pointing out that obviously these are more premium suburbs to a degree, especially like Longueville, the the Lane Coves and the 5 docks and all that stuff. So not for your average investors who's looking at a sub 1 mil type of budget. This is more towards the high ones, the low twos, and I mean Longueville, you're talking about 5 here.
Oh yeah, I can't afford Longueville. Yeah,
that's definitely the premium one. Yeah. Yeah. So anyone who is looking to get into these markets obviously need to understand that your pockets need to be deep enough to be, number one, to be able to get in.
Yeah.
And number two, yeah, just be cautious. Yes, they are great suburbs, absolutely. But yeah, in general, Sydney is not cheap, unfortunately.
Yep.
So maybe John will do one that's more affordable for Sydney, maybe for units sub 1 mil, that type of stuff next time. So someone who's more interested or the smaller budget to play, then certainly that's something that they can consider as well.
Yeah. Well, an informal suggestion that we chatted about offline is the 3-bedroom apartment in somewhere like Hornsby. So that's sub $1 million, 3-bedroom units has done very well. And Hornsby's been a great performer. So that's I mean, there are lots of parts of Sydney that will do well. So it's not limited to 7 suburbs.
Yeah, absolutely. But these are just a small subset of what you think is going to do relatively well in the medium long term. That's for sure.
Keep an eye on.
Cool. Awesome. All right. No, thanks, John. Appreciate it. That's good.
Pleasure.
That's good. So hopefully that leaves our audiences thinking and listening and wondering, pondering about, maybe they'll busily searching the suburbs now, typing in the data to see what like. So all right, well, that's a wrap for this week. Thank you all for joining us, and have a wonderful week, and good luck on the Cups day. Don't bet your house on it, is the joke that talks about it. Don't bet your house on a day because you're probably going to lose everything. But otherwise, have a good and safe week, and we'll see you guys again soon. John and David.